Welcome to Breaking News to Trading Moves. Our goal, as always, is to break down what happened quickly and thoroughly so you're well informed about recent market movements. Today, we're really focusing in. We want to examine the fallout from a specific market event, see where the money moved, and basically lay out the winners and losers based purely on the data we've looked at.
Yeah, and the event kicking this all off was a pretty noticeable sell-off led by SoftBank. This wasn't minor. It directly hit AI-focused companies, and really it had a global reach.
Right, and that action immediately brought these valuation concerns bubbling to the surface, didn't it?
hmm
We saw those worries jump pretty fast from Asian markets over to their U.S. peers. So what was the first sort of measurable impact from SoftBank's move? I mean, SoftBank, especially its vision funds, carries some serious weight. People watch what they do, almost like a bellwether for tech.
Oh, absolutely. It's a
Yeah.
huge signal, particularly when you're talking about these really highly valued companies that depend so much on future growth promises. The very first reaction, a sharp drop. You saw it first in Asian tech stocks, the chip makers over there. And that move then basically turned up the dial on overall market uncertainty. It made investors everywhere take a harder look at the price tags on anything related to, well, what some people are calling the AI ecosystem. The key thing from that initial shock was this sudden dose of caution, this intense focus on companies whose recent stock prices were really banking on some very aggressive AI growth down the line.
Okay, let's dig into that atmosphere it created. Looking at the trading desks, the main reaction, it wasn't about bad earnings reports, was it? Not at first, anyway.
No, not initially.
It seemed purely about valuation, especially for those companies tied to those really big growth expectations from AI.
That's exactly it. And SoftBank's role is key here because, their vision funds are almost synonymous with betting big on long-term tech plays. So when a player known for being super bullish starts taking chips off the table, it kind of forces everyone else to rethink the risk involved. The market basically hit pause on that big AI rally. It made investors face that, well, maybe uncomfortable question of how much you should really pay now for growth expected years down the road, 3, 5, 7 years out.
Valuation's always tricky, subjective, but yeah, when a big name signals concern, the market almost treats it like hard evidence that maybe things got a bit overheated, and we saw that quantified pretty quickly, didn't we? The volatility indexes, the VIX, things like that, they reacted instantly.
Instantly. The cost of buying protection against market swings, or even just betting on more swings happening, it spiked. And that's not just, a feeling of worry. It's a hard number, a financial reaction. When the price of market insurance jumps like that, it tells you loud and clear that the collective view of risk just shot up suddenly. It goes beyond just a sell-off in one area. It becomes this broader institutional look at systemic risk.
Okay, so we need to trace how this spread. We know it started with this big global tech player, SoftBank, and the first big slides were in Asia. How did those jitters travel, from Tokyo or Seoul all the way to U.S. trading?
Well, like we said, the first weakness was in those Asian tech and chip stocks. Your memory makers, your big foundries, they're so deeply tangled in the global tech supply chain. So when they wobble, it immediately flags potential worries about global capital spending plans, CapEx. These aren't just local stocks. They're like the cogs driving the whole global tech machine.
Right, so if the companies building the factories, the ones making the physical stuff, if they're looking weak, how does that actually push down prices in the U.S. market, even if the selling started overseas?
It works through mainly two channels.
Yeah.
Sentiment and what we call compressed multiples. U.S. investors, they look globally. They see what's happening in Asia and think, okay, if the demand outlook or the big growth plans for manufacturing capacity are being questioned there, then our own companies here, the ones selling the tools or the chips or the software to those guys, well, they must be facing the same doubts.
Let's talk about compressed multiples. What does that actually mean for a U.S. stock when its multiple compresses?
It just means investors aren't willing to pay those really high prices anymore relative to the company's earnings, or, more often with tech, relative to their projected future earnings. So maybe a growth stock was trading at, say, 40 times its expected earnings last week. After this kind of event, investors might only be willing to pay 30 times. That immediately pushes the stock price down, even if nothing fundamental changed about the company's business forecast overnight. The excitement just cools off, that safety cushion disappears, and pricing gets more tied to today's numbers instead of those big future hopes.
So it kind of forces more discipline on the market. Okay, this whole backdrop, more volatility, clear risk aversion, investors demanding more proof. Now it sets us up perfectly to look at where the money went because capital doesn't just vanish, right? It rotates. It moves into places that either offer safety or actually benefit from all this movement.
Precisely. When holding high-growth tech suddenly feels too risky, investors start a very clear rotation. They move into things that either make money from the market choppiness itself, the volatility, or into assets that are just fundamentally more stable, your classic defensives. Understanding that rotation, that systematic shift from speculative growth towards stability, that's how we separate the winners and losers here.
Okay, let's examine that rotation then. The instability in AI didn't hurt everyone. For some sectors, it actually created a direct way to make more money or offered a really strong safety story. We can group these winners into, say, those benefiting from volatility itself and those acting like classic defensive safe havens.
Yeah, that's a point people often miss if they just watch the main indexes go down. A breakdown in one spot, a sudden jump in uncertainty, it means trading activity and hedging just explodes elsewhere.
So, first category of winners. The exchanges and market infrastructure firms. These are the actual platforms where all this nervousness and hedging plays out.
Right. Their whole business model is basically set up to profit from market stress. The mechanism is really direct and pretty powerful financially. Spiking volatility immediately leads to way more trading in options and futures. When investors get nervous, they're not just selling stocks like NVDA. They're buying put options to protect their portfolios. They're trading VIX futures to bet on more volatility. They're constantly adjusting hedges.
And for the exchanges themselves, all that activity means revenue. It doesn't matter if the market ends up higher or lower that day.
Absolutely. More trading volume directly means higher transaction revenues for them. Think about CME, ticker CME, handling enormous futures volumes on everything from interest rates to stock indexes. Or CBOE, ticker CBOE, where the VIX itself, the fear gauge, was born. Their transaction fees just pile up with every single contract traded.
Can we break down those revenues a bit more? It's not just a simple fee per trade, is it?
No, definitely not. All that increased flow also gives a big boost to their data and clearing income. Every trade, every hedge, every adjustment needs their systems to process it, confirm it settles correctly. And often, traders need to buy their real-time market data feeds to even make those trades effectively. They're basically the toll roads of the financial system. They make money as long as people are actively using complex instruments to manage risk or maybe even profit from the uncertainty. Worries about an AI bubble pop up. Well, the tools that let you bet on those worries or protect against them, they become super popular, and that's great business for the platforms.
So the bottom line for CME and CBOE is that their business thrives on movement, not direction. A choppy day is a good day for the market operators.
It's simple financial plumbing, really. They're shielded from the valuation squeeze hitting tech because their customers need their risk management tools more when perceived risk is highest. They're selling the picks and shovels, during the gold rush, or in this case, maybe during the sudden scramble for cover.
Okay, let's shift to the second winner category, gold miners. This move into gold, it feels like the classic, maybe the oldest risk-off rotation there is.
It absolutely is. The main driver here is deep-seated psychology, really. It's driven by that sense of heightened systemic risk. That feeling pushes investors, both big institutions and individuals, to look for assets they see as safe. That's your basic risk-off flow. And gold, historically, has been the go-to safe haven against worries about currencies or sudden shocks in financial markets, especially when those shocks come from paper assets like high-flying stocks.
But it wasn't just the flight to safety pushing gold up, was it? There were probably some bigger macro factors, like currency movements.
That's the really important second boost. And often it gives gold more lasting support than just pure fear. When you get this environment of higher global risk, it often leads to a weaker U.S. dollar. See, when investors get broadly risk-averse, sometimes they pull money out of dollar assets and look for things priced globally, not tied to one currency like gold. And a weaker dollar generally helps gold prices because gold is priced in dollars worldwide. So if the dollar falls, it automatically becomes cheaper for buyers using other currencies, which tends to lift demand.
So gold gets a double lift. Fear driving demand and maybe currency dynamics making it easier to buy. How does that help the actual mining companies like NEM, that's NEM, and GOLD, ticker GOLD?
Okay, this is where operational leverage kicks in. It's why the minor stocks often jump even more than the gold price itself when gold is rising. Let's use a really simple example. Say it costs a miner a fixed amount, maybe $1,200, to dig up 1 ounce of gold. That covers everything, running the mine, equipment, etc. If the spot price of gold is $1,800, their profit is $600 per ounce. Simple enough.
Okay, $600 profit margin, got it.
Now, let's say the SoftBank news and all the risk aversion pushes the spot price up, maybe 10% to $1,980. Their cost to get that ounce out of the ground, still fixed at $1,200. But now their profit margin is $780 per ounce, $1,980 minus $1,200. That's an extra $180 in profit. Now, $180 is 30% of their original $600 profit. So a 10% rise in the gold price just gave them a 30% jump in their profit margin per ounce.
Wow, okay, that really shows the leverage effect. Higher gold prices mean much, much bigger profits per ounce for the miners, amplifying the benefit.
Exactly. So the gold miners, NEM and GOLD, they benefit from both things happening at once. Those risk-off flows, maybe a weaker dollar pushing the gold price up, and the way their business is structured just magnifies that gain into potentially much higher earnings. It's the textbook rotation into safety, but with a built-in amplifier.
Our third winning group is maybe the most subtle, regulated utilities, but specifically those with data center tailwinds. Utilities are usually seen as slow, steady, defensive plays, yet here they are, holding up while flashy tech stocks stumble.
Yeah, this specific group is actually a pretty smart play by the market because it's trying to achieve two different goals at the same time. It blends that traditional defensiveness with a very specific growth story, one that's ironically tied to the same technology, AI, that's causing all the nervousness elsewhere.
Okay, let's break that down. Start with Benefit A, their classic defensive reputation. Why do companies like EXC, ticker EXC, and NEE suddenly look attractive when things get choppy?
Well, utilities are essentially regulated monopolies. They
Yeah.
provide stuff everyone needs: electricity, gas, water. The revenues are incredibly stable, very predictable, often sort of guaranteed by regulators. So during uncertain times, investors love that stability. They want companies that will keep earning predictably, whether AI stocks are flying high or crashing low.
Yeah.
They offer safety, often with reliable dividends, which feels good when holding cash or growth stocks feels risky.
But just being defensive usually means giving up on growth potential, right? The utility sector isn't known for explosive growth. That's where Benefit B, this growth cushion, comes in and makes these specific utilities interesting.
This is the key difference. Certain utilities are seeing huge new demand coming specifically from these massive data centers. Think about it, all these advanced AI models, all the cloud computing, they need incredible amounts of power. A single large AI data center can seriously use as much electricity as a decent-sized town.
Yeah, I've seen some numbers comparing the power draw. Like a regular office server room uses X amount, but an AI facility packed with GPUs running constantly uses many, many times that.
Exactly. And this huge nonstop demand gives a real growth boost to the utilities that are in the right place to supply that power. It helps offset that typical slowness you expect from a purely defensive stock. So companies like NEE, which operates in areas with fast population and economic growth, or EXC, serving big, power-hungry population centers, they almost become a way to play AI infrastructure growth without taking on the valuation risk of the chip companies themselves.
Can we talk about the money side of that? Are these power deals with data centers structured in a way that locks in that stable revenue for the utility?
Generally, yes. They're usually secured with long-term contracts, often called power purchase agreements, or PPAs. These PPAs basically guarantee a certain level of power consumption and provide a regulated return on the investment the utility makes to provide that power. It's different from selling power to homes, which can fluctuate with the seasons or the economy. Servicing a giant data center gives the utility a super reliable, high-volume customer they can count on for potentially decades.
So the reason EXC and NEE did well isn't just they're safe utilities, it's that they're strategically placed to benefit from the huge power needs of the very AI tech that spooked the market initially. Investors got the stability they wanted, plus a way to stay exposed to the long-term AI build-out theme, but without the immediate valuation headache.
It's kind of the perfect hedge in this scenario. You're betting against the high valuation of AI, but you're betting on the physical power needed to actually make AI work.
Okay, now let's flip the coin. When a major player like SoftBank signals caution, where does the selling pressure hit hardest? We're looking at the sectors that were most exposed to doubts about high valuations and those really aggressive spending forecasts for the future. This is where that valuation compression really bit.
Yeah, these are the stocks that had ridden the exuberance wave the highest. So naturally, they had the furthest to fall when caution crept in. They were priced, assuming exponential growth would just continue forever. Any sign of slowing down, even if growth is still pretty high, gets treated like a major problem.
And the most obvious first target for that skepticism, the AI chip leaders and the whole GPU ecosystem. These companies were, well, the absolute darlings of the AI boom.
No question, they were the purest way to bet on AI enthusiasm. Their valuations, their price to sales, price to earnings ratios, they were all based on this idea that global demand for their super powerful chips would just keep accelerating nonstop. The assumption was that every company, everywhere, would need massive, immediate upgrades.
So what happens when that sector-wide enthusiasm suddenly cools off, maybe triggered by a big institutional move like SoftBank's?
That's when valuation compression hits this group first, and usually hardest. When investors start questioning the speed of AI rollouts, or maybe they start questioning the actual long-term payoff for companies spending billions on AI, well, the market starts a derating process. The general view shifts from buy at any price to something more like, okay, show me the proof of steady, profitable use.
Let's talk about that D-rating for companies like NVDA, ticker NVDA, and AMD. They're right at the cutting edge of this demand.
Their stock prices are incredibly sensitive because the whole reason people own them is based on believing in that continuous accelerating spending on AI infrastructure. Their prices already baked in years of perfect execution and unending demand. So if the market even suspects that maybe next quarter's AI spending by the big cloud companies might be just a tiny bit lower than expected, the stock reaction gets magnified hugely.
Why magnified? Why is the drop so much bigger than maybe just a small tweak to the forecast?
It's because of that reliance on exponential growth.
Yeah.
If a stock's trading at, say, 50 times its future earnings, that super high multiple is only justifiable if earnings keep rocketing up year after year. If the slope of that growth curve flattens even slightly, the justification for paying 50 times earnings just vanishes. The stock gets marked down quickly to maybe 40 times or 35 times. The market isn't just adjusting the forecast number, it's changing the rules for judging the company. They were being judged on perfection, and any hint of hesitation leads to a big drop, punishing anyone who bought in at those peak multiples.
That leads us pretty logically to the second category of losers, semiconductor equipment makers, especially those with lots of exposure to Asia. If people are questioning future sales of the chips themselves, then the companies selling the machines to make those chips are obviously next in line for scrutiny.
Exactly right. Their fortunes are tied directly to spending decisions made overseas, specifically the capex plans of those huge memory chip factories and semiconductor foundries, many located in Asia. U.S. companies making the tools, they supply the absolutely essential, super specialized equipment. Things like EUV lithography machines, complex gear for depositing materials, etching systems. They sell all that to those Asian facilities.
And these aren't small purchases. They're massive machines, costing millions, taking a long time to build and install.
Exactly. We're talking about firms like AMAT, ticker AMAT, and LRCX. Their earnings depend entirely on their big global customers, sticking to aggressive schedules for building new factories, fabs, and upgrading existing ones.
So if SoftBank's move causes jitters in Asia, and maybe those big manufacturers over there start rethinking their spending plans because they see demand potentially slowing down, what's the immediate impact on these U.S. equipment companies?
They face immediate, very real order risk. If a big customer in Taiwan or Korea decides, okay, we're going to push back opening that new fab by 6 months, then the U.S. company scheduled to ship a key piece of equipment sees that expected revenue delayed, or maybe even canceled. And that risk, the risk of future orders being delayed or shrinking, that translates immediately into pressure on their stock multiple back here in the U.S.
And there it is again, the multiple compresses. Suddenly, the market views these companies as less certain to hit those big earnings targets maybe 3 or 4 quarters from now.
Precisely. The future earnings look less secure. Because their equipment orders are so large and so fundamental to the whole semiconductor cycle, they're among the first to feel the pinch when confidence about global manufacturing plans starts to wobble. It really highlights that direct link between global capex sentiment and what these equipment providers might earn in the near future. They need their customers to keep spending aggressively to support their own high valuations.
Okay, finally, let's look at the high multiple AI software category. These are the companies selling applications and platforms, often trading purely on the promise of future dominance. They might have fast revenue growth, but maybe not much profit right now, kind of that AI now, profits later story.
Yeah, this group, think about names like PLTR, ticker PLTR, and SNOW. They often carry extremely high valuations based entirely on the expectation of huge future earnings once AI gets widely adopted across industries, business, government. They might be pulling in a lot of revenue, yes, but often their current profits, or lack thereof, or their cash burn, doesn't really justify their market cap using traditional math. They're valued on the future story.
So if the market is starting to question the immediate pace and the guaranteed payoff of all this AI spending, which it clearly was after the SoftBank news, these names must be incredibly vulnerable, right?
Oh, absolutely. The most sensitive.
Yeah.
They are acutely sensitive to any shift in sentiment about that long road to profitability. They really depend on the market keeping the faith, maintaining confidence in their eventual dominance, regardless of today's bottom line. So when valuation worries flare up everywhere, the market's de-rating process for this category can be incredibly fast and, frankly, pretty brutal.
How does the market force that re-rating? What actually changes in how investors look at a high multiple software stock during times like these?
The focus snaps back. It shifts away from just revenue growth at all costs towards more immediate financial health metrics. Things like gross margins, how much they're spending to operate, are they burning through cash? Investors basically stop tolerating business models that rely on spending tons of money today, hoping to grab market share for tomorrow. They start demanding proof that the concept works now, not just in 5 years. The speculative nature of this category means that when risk appetite dries up, the market hammers companies that rely purely on aggressive future guesses. These high multiple growth stocks become prime targets for correction.
It really paints a clear picture of how money moved in direct response to those market jitters that started with that SoftBank action. The capital flows were quite specific, weren't they? Targeting businesses offering guaranteed trading volume, tangible assets like gold, or that regulated stability plus growth from utilities.
Yeah, let's just quickly recap that core flow we analyzed. A key move, driven by SoftBank, created real uncertainty about valuations, and that immediately set off a predictable movement of capital across global markets.
Right, and that movement was characterized by money leaving the areas that had seen the biggest run-ups in valuation. That included the AI chip leaders like NVDA and AMD,
Mm-hmm.
the essential semiconductor equipment providers like AMAT and
Yeah.
LRCX, and those high multiple software names like PLTR and SNOW.
And at the same time, that capital flowed pretty directly into segments that either benefited immediately from all the market churn or offered serious stability. So the volatility winners like the exchanges, CME and CBOE, the classic risk-off plays like gold miners, NEM and GOLD,
Right.
and those resilient regulated infrastructure companies, specifically utilities getting that data center growth boost like EXC and NEE. It's really a textbook example of how markets systematically reallocate funds to manage a sudden rise in perceived risk.
It really shows that even when one high-profile tech sector gets volatile, the ripple effects, the dynamics create real benefits and opportunities in places that might seem totally unrelated at first glance.
Indeed, it's all connected.
So, to leave you with something to think about, based on what we've discussed, how durable is that defensive plus growth story for the utilities? What happens if that huge data center demand eventually slows down? Or maybe new technology makes data centers way more power efficient down the road? Could that growth cushion that's helping EXC and NEE now actually become their next valuation problem? Or are those long-term power contracts really strong enough to ride that out?
That's definitely something worth watching closely in the quarters ahead.
Okay, thank you for joining us on Breaking News to Trading Moves.
And just a reminder, this analysis is purely the opinion of the author of the material provided. This is not financial advice or a recommendation to buy or sell any of the named assets.